Okay, this is the last job costing problem that we did in class, and so you're going to need a copy of the problem itself, and then what I'm going to do is I'm going to replace this and put the solution here. Okay, so the first thing you want to do is take a look at the way they gave you the information, and we've got things like sandpaper, material handling, coolants, lubricants and coolants, miscellaneous indirect labor. These accounts, like it sounds like sandpaper. These would be part of raw materials, but what you want to think about is it a raw material inventory item? Okay, would you keep it would you consider that sandpaper a raw material to make a product? Okay, it might be something that you use more like a supply, all right, but it wouldn't be a raw material. And materials handling, I think what they're referring to here is like moving materials around the place inside, like say in manufacturing, so that would not be an inventoriable cost either. Same thing with lubricants and coolants. These are things that you wouldn't track separately, but it would still be something that you'd use. And then the last one is miscellaneous indirect labor. So, and you know, at least they gave you a big break here and said indirect, so you know that it's overhead. So all four of these are going to be manufacturing overhead. Okay? Then we've got, okay, direct labor, that's good. Materials inventory, beginning and end. Finished goods, beginning and end. Work in process, beginning and end. And then a whole bunch of other ones. Plant leasing cost. Okay, so it's plant leasing cost, plant depreciation, property taxes on the plant, insurance on the plant. Okay, and then we've got direct materials purchased down here. But these accounts right here, okay, these would all be overhead accounts. Whoops. No. These would all be overhead accounts. Okay, I gotta start up with plant leasing. So it goes down here to fire insurance. These would all be manufacturing overhead accounts. Okay, and then the rest of them, we've got direct materials purchased, then revenue, and a bunch of marketing costs. Promotions, salaries, distribution costs, customer service costs. That's all selling expense, all of them. Okay? So what we're going to do is we're going to do the T accounts first, and I can only encourage you, I mean, it's asking for a cost of goods manufactured in proper form and then an income statement, but do the T accounts first because then you know where all your numbers are. And you're not going to miss anything. It's safe. I mean, you can go right to the finished thing if you want to, but boy, if you make a mistake, you know, what am I supposed to do with that? I can't really I can't help you then. Okay, so let's get a different piece of paper. Okay, and I'm going to put on I'm going to put my T accounts at the top. So they're calling this, what are they saying? This is all direct materials. We don't seem to have any indirect materials. So I'm going to have a direct materials T account. This is an inventory account. Okay, then work in process. You know, leave enough space for 4 lines. It'll always be that. And then finished goods. Oops. Oh, that's all right. Finished goods inventory. All these three are all inventory accounts, right? Okay. And then I'm going to put I'm going to put MOH here. We only need the debit side anyway, and then I'll show you the one big credit, okay? All right. So the first thing that we have is we can put our beginning and ending balances in. So for direct materials inventory, my beginning balance, I'm going to put a little BEG there. My beginning balance is $40,000. And then I'm going to draw a couple lines because I like this, even though you guys don't. All right, here. But, okay, your ending inventory then is going to be $50,000. Okay, so, and if you want to, what you can do is you can check these off as you've done them. So we did direct material inventory. Let's do, well, we can go through the beginning and ending balances first. So they got finished goods next. Finished goods has a beginning inventory. Beginning inventory of 100,000. The ending finished goods inventory. This is a short one. We don't need a lot of space here. The ending finished goods inventory is 150. Okay, so I've got those two. And then work in process inventory in January is 10,000. Beginning is 10,000. And ending is 14,000. So we're going to take a little bit of space here. Okay, 10 and 14. And what else do we know? They gave us some, I'm going to put in direct manufacturing labor there. Now this work in process is going to be direct materials, direct labor, and manufacturing overhead. Okay, that's what's going to be there. So you can put these in and drop these numbers in as you need them. Okay? Make sure you can see this. Okay, then what else do we know? We got 300 then. They gave us, oh, direct materials purchased were 460. So purchased are 460. So now we know that we've got a subtotal here. I've got a total of 500,000 sort of available. You know what I mean? And if this is going to be 50,000 at the end, our ending balance is 50,000. That means that we took, this has to be 450. So we've got 450 coming out. Now this problem didn't have any indirect material that came out of here, okay? Sometimes it's there and sometimes it's not. So I'm going to move that right over into work in process. Okay? Alright, then for our overhead, I've got sandpaper. I'm going to put a little note there so I know what it was. It's 2,000. Sandpaper's 2,000. Handling is 70,000. 70,000. The lube, whatever, is 5. We got some kind of miscellaneous stuff. Indirects, 40,000. I don't have enough space so that you can see it. Okay, 40,000. And then what else? The lease, the plant lease cost. It's a big number. That's 54,000. And depreciation. Depreciation is 36. Taxes are 4. And insurance is 3. Now don't forget with these videos you can pause them and catch up. You know, so then you can move right along. But, you know where that button is so you can get back to it. So I've got a total of 214,000 here. I'm going to take 214 out. Alright? And I'm going to put it down here in work in process. Okay, we're moving right along. So my total debits here are 974,000. The other thing I do at this point, well, for one thing, I always use commas to separate, you know, the blocks of 3 because that's the kind of mistake I make, okay? So I've got to be careful with that. And then after I put something like 974 there, I eyeball these numbers. So this is 4 plus 3 is 7, 8, 9. That's the right, you know, we're in the right universe anyway, okay? And we know our ending balance is 14,000. So that means that this total has to be 960,000. And then I go top down. So 974 minus 960 is 14. Okay, so you're sort of awake through it. So 960 comes out. That's cost of goods manufactured, which increases our finished goods inventory. And our goods available for sale then are 1060, right? Yeah. Would be 1060. And if we've got 150,000 left, then the amount that was sold would be 910. This has to be 910. So then again, go top down. So 1060 minus 910 is 150,000. Okay? And this 910, that is cost of goods sold. Okay? So now we've got everything that we need to know. We've got it all down, and we can do our cost of goods manufactured, and then the cost of goods sold, and then an income statement. So I'm going to slide this and leave that right there. I think it's my fingers. Let's see. Let's see if it fixes itself. I sure hope it does. But we're going to have cost of goods manufactured and cost of goods sold. And don't underestimate this, okay? Take a look at it and make sure that it's really clearly in your head. Come on. There we go. That's a whole lot better. Okay, so the first thing we do is we've got to do our direct material inventory. So, I mean, if we're really going to do a full job of this, that would mean I'd have direct material beginning balance of 40,000. And you're working right off the T account up there, okay? Plus purchases of 460. Gives us RM available. Or you could say direct material, sorry. It's 500,000. Less ending direct material is 50,000. So then I'm going to say direct material used, okay? So, you know, remember you're going to pay attention to these labels. Direct material used, $sign here because it's the beginning of a new column. That would be 450,000. Oops. Okay. Then I can add direct labor. Direct labor is 300,000. And what's next? Manufacturing overhead. That's 214. And this is manufacturing cost. $964. Now I'm using some abbreviations here, but when, you know, don't make this little tiny words that don't mean anything, especially if you're on an exam. I need to know that you see it. It can't be too cryptic, okay? But on the other hand, you don't want to have these great big long sentences because you don't have time. You definitely won't have time. So 964. So then I'm going to add beginning work in process. Okay, you can always call that the WIP. That's 10,000. And I called this cost to account for. That's sort of from process costing, I guess. That's 974. Less ending work in process. Ending work in process, how much was it? 14. Gives us cost of goods manufactured. Okay, big number. That's what we're looking for right there. That's one of them. So 960,000. Then check your math a little bit as you go down to make sure you didn't add another zero or something like that. The other thing you need to be able to do is write. And I think we type so much now, it's hard to remember that. So 960,000. Then, if I add beginning finished goods inventory, that was 100,000. That gives me goods available for sale. That's 1060 less ending finished goods. And ending finished goods is 150,000. gives us cost of goods sold. Okay, so cost of goods manufactured flows into finished goods inventory, and out of that we get cost of goods sold. And when you think about it, you can see it, but it's easy to forget this on an exam. So there's cost of goods sold. Okay, and that's the other one that's so important. Alrighty, what did I want to tell you about this? I can't remember. So now let's do an income statement. Okay. So this, the first thing we had to do was this, cost of goods manufactured and cost of goods sold. Now we'll do an income statement. Alright, and we've got revenues, sales revenues of $1360. Okay, and then less cost of goods sold, $910, gives us gross margin, $450. Yeah. And then I'm going to just say less selling, general, and administrative expense. And what that is, it's the 60,000 and 100,000. I'll show you in a minute. And 70,000 and another 100,000. And that comes from right here in the problem. These are all marketing expenses. Okay? So those are period costs. Period cost, not a product cost. Okay? They're not inventoryable at all, anything like that. So how much is that? That's 330,000. So operating income is 120. Okay, there's a lot to this, so you want to make sure that you can do it without looking at the solution, right? That's the plan. So what else do I have here? Okay, now the next thing they want to know is the cost per unit. For direct material. So direct material used was 450,000. And that's assuming we've got 900,000 units. So that's 50 cents a unit. Okay? And then they ask for the plant leasing cost. And that's a fixed cost. That would be 54,000 divided by 900,000. And we get 6 cents a unit. Okay? The next one, 4, says, well, what if instead of having 900,000 units, now we've got 1,000,000 units? Then my direct material would still be 50 cents a unit. Because variable cost is the same per unit, right? Okay, the variable cost per unit isn't going to change. It'll change in total, but per unit it won't. All right, and then plant costs, these will change though. Plant is going to be 54,000 divided by 1,000,000. That gives me 0.054. So it's decreased a little bit. And then the last question says, well, how come, what would you tell management? And just to keep it simple, what I said was that fixed cost per unit decreases with increases in volume. Okay, so that's it. And if you can do all these problems, you'll be in great shape for that first piece. My hands are a mess. Alrighty, okay. This is pretty long.